Hi, and welcome to your Global Markets Technical Outlook for the end of Q1 of 2021. Normal disclaimers apply, of course, and kick straight off with the US stock market. And on the monthly chart here, we can see how the trend is still intact. We're still in that massive uptrend that's gone on since 2009, really. You can see with the size of the bars here, this is arithmetic scaling, that the volatility is remaining elevated, particularly since the pandemic lows of 2020. We're making an excursion outside that top time, so we're starting to look a little bit extended to the upside, dare I say even overbought to the upside, but that 4,000 number just seems to be beckoning this market on and on. So I would certainly not be surprised if we hit that 4,000 level at some point in the near future. On the weekly chart here, we can see the picture very similar. We've broken out of that megaphone pattern and just carried on straight up in a straight line almost. So that breakout, I guess, has to be taken seriously now. It's starting to look less and less like some sort of bull trap, and it is now a bona fide breakout, I'd say. Just starting to see the market losing some momentum as it sort of starts to turn more sideways there. You can see the overlapping bars there, and we really haven't made a lot of ground, certainly this year, in fact. But once again, that 4,000 level just seems to be too close to ignore now, and it would be a surprise if the market didn't go up at least and tag that level. I think what we'll also find, though, is that 4,000, like all these large round numbers, act as a sort of psychological barrier, and we probably will find that it will be an area of resistance, and we will see supply coming into the market, at least on the initial touch as it gets up there. On the Ichimoku chart, obviously still well above the cloud, so still technically bullish on the Ichimoku, and the cloud pattern here between 2,900 and 3,300 down below. So a fair distance down this market would have to travel to connect with that cloud. Turning to the market fundamentals now, and just picking up a sign of some divergence here on the bullish percent index. You can see this is the market down the bottom here. The S&P has been rising solidly since the pandemic low of last year, but each subsequent new high in the market has been met with a smaller and smaller percentage of stocks making breakouts to the upside. We're now sitting at 66%, which is a smaller number than you would hope for at this stage of a bull market, and that does just show that the market might be starting to run out of some steam, and we'll have a look at the reasons why that might be when we get a bit further into the presentation. But it just also makes me think if it does hit that 4,000 level, it's going to be much more fragile if supply does come into the market, and we might get some bigger sell-off at that stage. Stocks above their 200-day moving average across the whole market, so looking right across the whole NYSE, is actually still a very healthy number, sitting up there at 83%. But just sort of starting to show signs of dropping off there towards the end. But this is still a healthy number market wide, and as you'll see in a moment, where the weakness is concentrated in one single area, which is actually quite a large portion of the market in market breadth. Market cap terms. The new highs versus new lows, once again, still a healthy number. There's still more stocks rising than falling. So once again, that's still reasonably healthy for the bull market. But even despite the fact that things are starting to wane a little bit. Same on the advanced decline line. We're still seeing this line move higher and higher. So if you take all the individual elements, the stocks on their own 2 feet, as it were, without market cap weighting them, there is still quite a broad-based support for this uptrend. Here comes the however, where we're seeing weakness coming into the market is concentrated primarily in the tech sector. And this chart here shows the ratio of the semiconductors, which is one measure of the tech industry, versus the S&P 500. So you can see right from, in fact, from the last couple of years, really, didn't really miss a beat through 2020. The semiconductors have been outpacing the S&P 500, but now you can see just in the last month or two that relationship is starting to change as we've had a big pullback in that relationship. Another way we can look at that weakness in the tech stocks is to look at the NASDAQ bullish percent index, and you can see here that the NASDAQ's been weak the last month or so, and you see it's only 39% of its stocks, so 39 out of 100 stocks are unable to make upside breakouts, so they're either going sideways or down. And if we look at how the three major indexes have behaved relatively just for the start of this year, you can see that it's quite a dramatically different picture to what we saw last year. The NASDAQ being the laggard, really, not even breaking even for the year. S&P's up about 3 or 4%, but it's the Russell that's bombing away to the upside. It's the one that's been the bullish. So we're seeing a rotation out of those what you might call growth stocks into the more what you would call value stocks. And so that rotation is benefiting the Russell at the cost of the NASDAQ. The S&P, of course, sits in the middle because it's kind of contains half of the stocks from one and half from the other. And if we look at that, the NASDAQ, just the NASDAQ versus the Russell, if we isolate, you can see here how last few years the NASDAQ's really been outpacing the Russell no problem. And when 2020 struck and the pandemic hit, of course, it was all the tech stocks that did really well out of the pandemic. You know, the big stocks, you know, Facebook, Apple, Amazon, Google, Zoom, you know, all those things, which are all components of the NASDAQ 100. But you'll see that relationship change towards the end of last year, and now it's almost the opposite. The Russell making much better ground now than the NASDAQ. But why does that matter? Well, it matters because the top 5 tech stocks here, Facebook, Apple, Amazon, and Google and Microsoft. Alphabet being the group company name of Google. Well, they are making an increasingly they're taking up an increasingly large percentage share of the S&P 500. The S&P 500 obviously is a market cap weighted index, and the top 5 tech stocks here now make up over 20% of that index. So whenever there's weakness in that tech sector, particularly for those big tech stocks, that feeds through to the rest of the market. And what's the reason for that? Well, one reason is we're seeing this is the yield curve, and while the yield curve is still in this nice risk-on shape, you can see by these shadow lines here, which is where the yield curve has been recently, that the whole curve is moving up. So that means that yields overall are rising, bond yields. So that means the cost of money is rising, and that has 2 effects on the stock market. One is it reduces the amount of leverage that's in risk assets, so that has a dampening effect on the price rise. And the second one is that if you can get more or less the same yield in bonds than you can in stocks, well, you might as well be sitting in bonds because they're less risky. So you get that rotation out of stocks and into bonds. The current yield on the S&P 500 is about 1.5%, and you can see here that the US Treasury just in the last sort of 6 months is now sitting up at that same level. So if I'm getting 1.5% from my Treasury bond, and I'm having to take all the stock market risk to get more or less the same yield, then why not just rotate out of stocks and into bonds? And particularly those big tech stocks are exposed when it comes to rising yields. So those are the ones that will tend to get sold off, as we've seen happening recently. On the sentiment indicators, we're seeing that we're still down in this very bullish area. There's still a lot of calls being bought versus puts. So that's keeping us down in this elevated risk to the downside. In other words, the market's being overbought. and that eventually will likely eventuate in some sort of corrective event in the stock markets itself. So we'll see how that plays out over the next few months. As you can see, it's been in this state for a number of months, it's most of this year in fact. So we haven't really seen the knock-on effect of this just yet. On the VIX, you can see here that once again, through this whole recovery from the 2020 low, that whilst the VIX has come down, it's still remained in this elevated state. So there's still a bid on volatility, if you like. In other words, there's a lot of people demanding protection for their assets. And that there doesn't seem to be any sign of that changing and us reverting down to these low volatility regimes that we've seen in the past through 2019 and earlier bull market periods. So this is one to watch. We may have to go through another spike before we get back down to this lower risk area. So in our continuing series of where to from here, we'll see if we can sort of look back in history and make the case for both the bullish and the bear case from here. On the bear case, some people saying that this is starting to look a bit like coming into 2020. So the blue line here is the Nasdaq as it today, and the purple line is what especially this earlier period here is what this was 2020 last year through March and April. So that's one scenario, that we do have some sort of big sell-off like we did around about this time last year. I think this is probably a lower probability outcome, but you never know, and it's certainly one scenario to consider. And on the bull case, well, the Nasdaq's still very bullish, and perhaps we make some move like we saw back in 1999. We're still getting a lot of the fire hose of money from the Fed is still firing into this market, and that all has to find a home somewhere. So perhaps if bond yields start falling a little bit again, then we get a rotation back into stocks and we get something like this. So who knows? It's anybody's guess at the moment. But on the seasonality side of things, on the annual seasonality, I've got the S&P 500 year to date down the bottom here. It's probably a bit early to draw any conclusions other than to say that, well, January and February can often just be volatile months, a bit up and a bit down, and that's certainly what we've seen in the first part of this year. So coming out of the back of this, it looks fairly bullish through March and into April before it sort of tails off for the northern summer. So perhaps we do see one more leg up before we enter some more consolidation phase, for example. Of course, last year was the presidential election year, so this year is the post-election year, and this is what the cycle for that year will tend to look at on average. Once again, I've got it's the Dow this time year to date on the chart here. Dow making new highs at the moment. We did have a low there just at the start of February. That doesn't quite line up, although they do have a low in February on the cycle. Once again, though, it does show a fairly bullish time from March forward and up into the middle of the year. And the president in the US has got his COVID recovery package through the Congress now, so that's going to inject a lot of capital into the economy and may well feed into more recovery, and the stocks that rely on that recovery may start to do better. So that's one scenario you can see where we might see this playing out to the upside, but again, probably a little bit too early to draw any conclusions just yet. On the decade cycle here, we're just in this the start of year one here. This is just a pure average of returns and pricing, and you can see here that according to this, we towards the middle of the year we might sort of start to lose a bit of momentum and perhaps sell off in towards year two. Again, too early to say if any of this will happen. And Calvert Clark said decade pressure cycle here. You can see where we are, where this pink arrow is here, that the rate of change of the market might just start leveling out as we get into the middle of this year, and then we'll start to see some negative rate of change going in towards year 2 there. So again, that will line up with the last chart there, and we'll see. We'll obviously keep an eye on that as we go through this year. Switching now to the Aussie stock market and monthly chart of the ASX 200, and you can see here how it's just having another second attempt at this all-time highs after failing miserably the first time, and it's just coming up and getting trapped under that all-time high there. It's obviously been very strong coming out the back of that recovery, but now seeing those long spikes on top of the candles just indicating that, you know, the sellers are pushing the buyers back as they get up to those levels, and the bodies of the candles getting smaller and smaller, just indicating just a loss of momentum there. On the weekly chart here, we can see that once again, you know, that sort of just gives us a sort of zoomed in picture of it. What's interesting here is the momentum's obviously been very strong coming up into this area here, and just the market now just looking more sideways and basically done nothing for the whole of this year, and, you know, the market momentum just dropping off. So it really needs to make a move and break out soon. Otherwise, for my money anyway, it's more likely the bears will have the upper hand. On the comparing us to our sort of friends and neighbors across the world, you can see that the Hang Seng has actually done the best of this bunch, whereas the Shanghai is way down, lost 3% for this year, and the our market and the S&P 500 sort of more or less in the middle there. We're up about 2%, and the S&P's up about 3%. So nothing to write home about at this stage, and you can just see, you know, those lines just kind of wiggling in and out of each other going across the page. So it's lacking in any sort of trend or direction or upside momentum at this stage. On to the currencies now, and kicking off with the US dollar index. And you can see that dollar weakness that we've had. It's come right back to this previous line of support at 90. And so it will be interesting to see if this, you know, on its second visit here after breaking through that barrier back in 2015, whether it will be able to actually turn around and start making hay to the upside, or whether this is indicative of something a little bit more dramatic and we see a drop through that level. The Aussie dollar's obviously done quite well out of that dollar weakness, also strong iron ore price and so on. Just sort of ran into a bit of supply at that 80 cents level and has pulled back. So that's now the level to get across. You know, it looks like it's just sort of consolidating under that level. Does it have the strength to get across that level? Probably will depend on more dollar weakness and iron ore strength, or do we see a rotation back towards the 70 cents area? But would have been a perfect short-term short just off that 80 cents level for sure. On the euro, another currency that's making hay out of the dollar weakness, and you can see it's definitely broken out of this downtrend line. Now we have to kind of take notice of that because it's spent quite a few months above that level and just sort of testing, been through this 120 level, just coming back and retesting it at the moment. So if it can hold that 120 level for another month or two, I think then the upside would start to look very positive for the euro. British pound also running into a bit of headwinds around about $1.42 here. But you know, looking pretty bullish. Obviously the vaccine rollout in the UK has gone very well, and they've got, you know, the shots in a lot of people's arms very, very quickly. So their economy looking like it's starting to recover. They're talking about opening up completely by June. So that's going to be good for the British pound. And on the Japanese yen, just this symmetrical triangle I've had my eye on, just looks like it now might be a little bit of a sort of bull trap there at the top of it, just coming back and selling down. It's obviously a consolidation pattern in a large downtrend, so probably no surprise that the break eventually heads for the downside. And on Bitcoin, well, it just keeps going and going, doesn't it? So it's now up 1,300% from the lows back in 2020 last year. So, you know, on and on it goes, and where it stops, nobody knows. It's defying logic and all forecasts and predictions. But it's up at 55 something thousand US dollars. Some people are already talking about 100,000. I've even heard a couple of people offering up $1 million. So who knows? Is this just going to keep going and going? It would be difficult to try and get set at these levels. I mean, I'd certainly be wanting to look for some sort of pullback or consolidation area before getting involved up here at these nosebleed levels. And finally, to the commodities, oil doing quite well. Again, these are all the commodities are basically inverse to the US dollar, so that dollar weakness is going to help them breaking through this old trend line, which I think is significant. Up around 65 there, and I think 75 or 76 now the target for oil. And soybeans starting to defy gravity as well. It just keeps going to go up and up and up. So very strong on the soybeans. Maybe just starting to lose a little bit of momentum as we see those candles just slowing down up there. But that's a bullish breakout for sure. On the gold, it now looks like we did see some sort of bull trap here where it broke through that old 1925 level, but it's now getting quite seriously sold down. And despite the fact that there is a weak US dollar, so there's definitely something more structural going on here. I think if US dollar turns around and starts strengthening, that's going to be further weakness for gold. So who knows? Maybe Bitcoin's the new gold. We'll have to wait and see. Copper is doing very well out of the recovery. It's obviously an industrial metal and used in many things, and it's having a heyday at the moment, which means that this is generally a good sign for the economy more broadly. That as things start to open back up, and if Dr. Copy's happy, then the economy in general should also be happy in due course. And lastly, to iron ore, broke through that 126 level, and it's just showing no signs of stopping really. It just wants to keep going up and up and up. So very bullish for iron ore at the moment. So just to summarize, the US stock market, we are just starting to see some structural downside risk, I think, just coming in. There's just a few risks appearing on the horizon. We've got rising yields, of course. We've got the tech sector weakness and so on. But that 4,000 target for the S&P just seems to beckon just above where the market is right now. So again, I would be surprised if it didn't go up and tag that level. Aussie 200 market very sideways, as you've seen since the first 3 months of this year, hasn't gone anywhere and still trapped under those resistance at the all-time highs. On the currencies, US dollar weakness, most of the others fairly bullish apart from maybe the Japanese yen, which is a little bit more sideways. And on the commodities, as we've seen, that weak dollar just feeding into commodity strength. That'll do it for this time. If you have any questions or want to send me an email or anything you want to discuss, drop me a line. There's my email address. Check out my offerings on the website, and if you want to, please feel free to pass this material on to anyone who you think can benefit, and if they want to sign up for themselves, just jump on the website and drop their email address in. That's it for now, folks. Hope you have a good quarter coming up. Good trading, and goodbye for now. Bye.